All right, guys, welcome. I'm glad that you're here. If you're someone who is seeking uncommon results, this podcast is for you. Success, happiness, and wisdom. What do these words mean to you? I think we can all agree that we'll probably all have slightly different definitions of each. In these podcasts, I get to dive deeply into conversations with some amazing innovators, influencers, and trendsetters that have had different versions of how they define the terms, yet have come out on the other side with amazing, uncommon results. At some point in their lives, they have decided to unshackle themselves from the norm and go beyond all boundaries. Well, again, this is John Dwyer, another episode of Beyond All Boundaries. And I have Jack BeVier with me today. Jack, thanks a lot for jumping on and spending some time with us today.
No, absolutely. Really appreciate it. Thanks for having me, John.
You bet. So Jack is with the Domino Group. And in 2007, is that when you joined the Domino Group?
Yeah.
Okay. So why don't you give our listeners a little background on just what the Domino Group is, and then we'll dig into some of the cool things that you and I were talking about prior to the call here.
Yeah, sure. So Dominion's a single family real estate investment company. My partner, Fred, started the company in 2002. I came in 2007 at 23. So got into the business very early, which has been great. And we've just been really kind of growing the platform since then. We do a bunch of different stuff in single family distressed real estate. So we buy houses and renovate them, either keep them as rentals or flip them and sell them to homeowners. We do a little bit of wholesaling as well. And then we have a lending business where we make fix and flip loans to investors and also rental loans for small and mid-sized landlords who are building their rental portfolios. We lend nationwide on those two things. So started in 2007, a much smaller company, and have really just been having fun growing it since then.
Yeah, I mean, we were talking right before we got on the call here, and when you started, there were 6 employees.
Yeah, exactly. Yeah, it was a much smaller company at the time. Just very entrepreneurial environment. Sorry, I'm in Baltimore, so I got an ambulance. Not pretty typical, actually.
Yeah,
In any 15-minute period, you'll probably hear an ambulance going by.
It adds color to the podcast, brother. Don't worry about it.
Exactly. There'll be more. Yeah, there'll be more. Anyway, yeah. So starting in 2007 as a much smaller company, and didn't have a whole lot of systems and processes in place. We were hustling, buying houses. It was really before a lot of institutional investors had gotten into the space, and before it was much more inefficient market than it is today. That good and bad, right? So we've had different struggles over the course of the past 15 years, but have had a fun time, growing the platform in this evolving market that where the world keeps changing every 6 months, which we still see.
So talk about when, because how many employees do you guys have now?
We have about 115 employees now, 15 in property management, 15 in the development side of things, and 85 in the lending company. So That's presented a lot of challenges, learned a lot of stuff along the way there. Our roles have changed very much along the way, through that growth, but yeah.
So talk about some of the things that you guys, from going to 6 to 100 and some employees, right? So talk about some of the journeys and the things, that you've had to experience, or things that, man, I wish I would have never done that again, or, things, what has made, Domino Group so successful, and what you guys are doing as far as a culture, and I've been asking a lot of questions here, right? But give me an idea of the journey that you guys have gone through to, sustain that many employees, because it does become a challenge.
Yeah, absolutely. So we always, we got into the business with the idea that we wanted to build wealth through real estate, and growing a rental portfolio has been like a main focus of that goal. But it's hard to build a rental portfolio from a cash flow management point of view. Like, that's something that we've always struggled with. Every year is cash flow planning. How many rents we'd like to set aside everything as a rental, but we need to pay the bills and the mortgage, right. And we would like to add a bunch of properties. So we need to make payroll. And so we've done other activities like flipping and wholesaling and lending that create current income to allow us to afford the staff and the infrastructure to continue to build the rental portfolio. And, we've made tons of mistakes. We were winging it, we've really just, been growing it as we go, and trying to figure things out as we go. we didn't hire an HR person, office manager until we had about 45 employees. We probably should have done that back at 20 or 25 in retrospect. And hiring and kind of getting the right people in the right seats the first time has been a kind of a constant struggle.
Jack, that seems to be a constant struggle with any business, any entrepreneur, even my own business, right? It's that phrase, the right people in the right seats, is so easy to talk about, but it is so difficult. My personal opinion, right? Like, you sit down with people and you think that you're going in the right direction. You think that you have them in the right spot. And it's really, I think it's a struggle. Unless you have your pulse on it all the time, that is a major challenge. And I don't know if you want to elaborate on that, but I just feel like it's a constant thing that every entrepreneur talks about, isn't it?
Yeah, absolutely. I mean, there's such power in leveraging other people, right? Like if you want to grow an organization, you need to be able to leverage the efforts of other people, but they can be very additive, or they can be very, negative to your productivity. And that right person, right seat is something that we struggled with for a very long time. And frankly, and still do. It's not like we've like cracked the code or anything, right. But something I will say that really helped us is maybe 4 years ago, we started using Culture Index, which is a personality profiling, personality survey and profiling, I guess, system. Predictive Index is very similar.
Predictive and Culture, I think they're similar, right?
Yeah, they're very similar. Math behind them both is pretty much the same. Like you look at the graphs and they're pretty much, it's just like they're the same. So like either approach works well, but something, even more so than DISC, or more so than Myers-Briggs. I found that when I started learning about and applying Culture Index, Predictive Index, it was much more actionable, right? Like it gave me and Fred and our managers a language to talk about differences in personality type. And so the conversation stopped being like, what's wrong with this person? And we were able to be like, this person is different than us in this quantifiable way. And as a result, we need to adjust our management approach because that's where we are going to have conflict, right? Difference in personality type is where you're going to have conflict. It's where communication styles are different. And that ends up being the source of a lot of like, I guess, conflict, or a lot of, getting the machine to work well, where people are the nuts and bolts of the machine. You really need to have a language to talk about personality, because that's the nature of the nuts and bolts in the machine. And when we started using Culture Index, Predictive Index, that really was a big leap forward for us in terms of, from an HR point of view, screening, getting the right person into the right seat at a higher percentage of the time the first time. And also from a management point of view, like being able to talk about the reason for conflict, or the reason for deficiencies in performance, where it wasn't just like, what's wrong with this person, which is it's not productive, right?
Right. And even from a partner standpoint, right? So I've joined a new venture with a colleague of mine in a new business as well. And we're going through the predictive indexes and understanding, the differences of who we are, Maverick and Persuader, and, all those different terms, right? But then also the areas where our strengths align, right? And then areas where they're not going to align, but then more importantly, how do we communicate through that and understanding that stuff from a partnership, right? Because partnerships are not always easy. And even identifying from a partnership perspective, like, okay, what things am I gonna, or Jack, you're gonna handle, what thing is your business partner gonna handle, right?
Absolutely.
And making sure that we stay in those lanes and allow that this area is what I'm taking care of. Obviously, communicate with your business partner, right? But then you can't both be making the executive calls on every decision, at least from what I've experienced, right? So having those conversations and then just where we're going to have conflict, where we're going to measure up, and where we're going to see eye to eye, and just it's really fascinating. I think those programs too are about 98 to 99% like legitimately accurate.
It's unbelievable. It's almost creepy, right? Like it was remarkably accurate. And to your point, like I got very lucky with Fred. We got very lucky with each other, frankly. Like we just happened to be the classic, like He's the visionary, I'm the integrator.
Yeah.
And we didn't know that those words existed. We didn't realize that like 10 years later, after we've been working together for 10 years, someone pointed out to us, it was like, oh yeah, you guys are like the classic duo. And we're like, Fred pushes it forward and does the strategic stuff, and I'm running systems and processes and operations, but still get the vision, get where we're going. And we just got lucky, right, with that. Like it would be, had we had some additional knowledge going in, that would have been nice. But as a result, it took us a while, frankly, to like settle into our respective roles, because we didn't realize the nature of each other. And so like had we had that pointed out to us earlier, we would have fallen into those roles much earlier, right? And gotten into a groove quicker even. So that stuff's really powerful. And I'm a pretty quantitative guy. Like I don't like the fluffy stuff. I was like, it took me a while to come around. Yeah. But I'm totally like evangelized at this point. So
yeah. It's amazing too, because even in the hiring process, and I'm sure you guys did this with culture, right? But you lay out the skill set or the tasks and duties, right? And then it's crazy how they can take the test and they score you basically how you're going to fit in all those areas. And I mean, just from that alone, you can determine whether you want to take that conversation with that potential new employee. And so many times I've gotten it wrong. Like I sit down with somebody because I'm an extrovert and I love talking to people, and I'm like, oh, this person will be awesome, right? But they're just like me, and that's a problem. Yeah. So it's not a good fit, right? But when you can objectively just sit back and let the scores and the tests identify like whether this person is going to be a good fit. And then more importantly, what you're talking about, how to communicate. You made a really good comment, like what's wrong with this person, right? Like why aren't they, but
there's nothing wrong with it.
That's not the issue, right? The issue is that the means of communication or understanding from an employment and an employer role can really change the outcome of the business and having people feel like they want to belong to something too, right? That they're not just coming in day to day to check the time card and punch in and punch out, because that happens so often in corporate America.
Yeah, absolutely. Yeah.
And I think, as entrepreneurs and, not major corporations, I think, some of the things, at least for me, is like corporate America, like I don't want it to be anything like corporate America. However, they get more into these trainings and these ideas, but really, I think at our level, we can implement them even in a better way because we can really dial into that,
Yeah. If we borrow the certain ideas that do work from a scaling organization's point of view, and like behavioral psychology and growing organizations, like if we apply those same principles, but in a much more nimble, context, I feel like we've got the opportunity to have a real competitive advantage there. But there's stuff to learn, there's stuff to take.
So what do you, I mean, as you guys have been growing, what's been one of the things that, I mean, obviously the culture index and protective index, but what other things are you doing to make sure that you're not growing too fast, right? Because there's some of that too, like making sure that you don't have such quick growth to where you can't sustain that model either. I mean, have you guys run into that at all with the business? Because you talked about cash flow, you're buying properties, right, for long term, but then maintaining that you're able to make the payroll, able to, put food on the table, right? There's that balance of not growing too fast either, to where your overhead gets to a point to where you have to make some major adjustments. Have you guys experienced any of that, or has it been kind of, day by day, week by week?
Yeah, no, definitely. I think the way I think about it is that, as you're growing the organization, like especially when you start hiring and you have specialization within your organization, you can't just like pour gas on the front end, right? Because the back end, if the back end's not ready for it. Right. So like, that's every entrepreneur's temptation, right? Like pour gas on the, I'm buying houses. I hit, I made a score. Like, I bet I could repeat that. And so you just like pour gas on marketing for whatever, right? And then, but you don't have the systems and processes in place to answer the calls, set up the appointment, do the analysis on the front end to screen, set up the appointments, set up your dispo side, have your books ready for it, make sure you have cash flow for it. Like, so it's this, growing the business is this balance of like trying to push, the guy on the soundboard, right? Like push everything up at the same pace is a really challenging, difficult thing, where you have to monitor where all the different aspects of the organization are at all times and see if something's breaking. Because if it's breaking over here, well, then you need to pause over here. Otherwise, you're just going to exacerbate the issue. And so kind of keeping tabs on where all parts of the organization are and making sure that you're kind of watering every every area at the same pace. That's for me, that's the tricky part, right? Like, and that's the thing that I think that we've done pretty well, but that's because we've spent a lot of energy on that idea, on that concept, and have done a good job, frankly, of not, breaking ourselves by ignoring, by being honest with yourself about what you're good at and what you're not good at, and then focusing on what you're not good at, because that's, if you focus on what you're great at, which is everyone's tendency, right? Like, that's human nature. You want to do what you're good at because it feels good. You get dopamine rush, but that's not going to help you grow the organization. You need to actually spend the most mental energy on what you're not good at so that it keeps pace with what takes less effort to grow. And then, grow it all at the same pace. That's like, that's for us been a key to continued growth without, sprinting and then being like, crap, and we broke it. We need to like back up and fix this thing for a year, and we missed market opportunities because we were fixing the thing that we broke. We've been a little more slow and steady, but even paced across all aspects.
I know you guys are doing a lot of stuff nationwide, but do you spend a lot of your time in Baltimore with the fix and flips, or where's your portfolio held?
Yeah. We still spend, I still spend more than half my time in the real estate operations. It's fun. I still like it, right? Like, we all got, everyone hopefully got into real estate because they enjoyed an aspect of it, or enjoyed the operations of it. And so, we still do. I still do spend a fair amount of my mental energy in the real estate aspect. Also, because it really helps inform the lending company. Like, lending is a more scalable thing, right? Because you're leveraging. You're just money. And all the money's green. So you're leveraging the operations of other people who are doing the real hard work of finding deals. And as operators ourselves, we have a healthy respect of that reality, that the guy adding value here is the one going to Home Depot and meeting with contractors and sitting at the kitchen table. These days, the money is not the end all do all. Whereas 10 years ago, that wasn't the attitude. But keeping grounded in the operations ourselves, I think, has been good for us so that we can understand the pain points of the folks that we lend to and understand where there's opportunities for those folks as well. Like for example, something that comes to mind is so we have a rental portfolio in Baltimore of about 750 houses, and we've always used bank capital to build up that rental portfolio. We'd buy houses, renovate them, and then we'd go refinance and try to get as much of our hard costs back out of them, and then go do it again. Whereas today, one of the things that we're offering in our lending company right now is a rental loan product, which is a 30-year fixed rate loan, and you don't have to deal with the local banks. You can close a loan in 40 days, and you don't have to provide tax returns. You don't have to have conversations with your banker about your debt to income ratio. It's about the rent from the property that's going to pay the mortgage. And is that private equity then, private funding from you guys, or is it from investors, or how do you guys deal with that? Yeah, that's what's amazing, is that this is now in the secondary market. Like, these loans are being securitized. And so the rates have gotten to the point where they're now in the 4s. So it is now competitive with bank capital. It's frankly head to head just a better product. And so had we as Dominion had our lending or real estate company, had we had access to this product, that's been a major pain point for us as we grew.
Well, it's a pain point for a lot of people with the banking institutions, right? You got to prove to why you don't need the money.
Exactly. Yeah. And single family properties they're relatively small balance loans. Your banker gets paid on commission. He doesn't really want to deal with your, looking into your QuickBooks and like figuring out what's going on there. He has to spend the same amount of work, whether it's a $200,000 loan or a $2 million loan or a $20 million loan. And so it's always been a struggle for us as real estate guys growing our own rental portfolio. And when we saw this product get into the, it's been out in the market, but the rates were in like the low 6s. It just, they sucked. It wasn't very interesting. But when they got into the 4s, when it got competitive with banks, we were like, dude, this would have changed the game for us. We would have gotten to 750 so much faster had we had access to this product. And so because we knew that, because we saw that as a tremendous opportunity with our real estate hats on, we said, you know what, from the lending point of view, this is what the market wants. And so I've been hiring like crazy this year. We've been growing that offering, a lot. And we'll close like 60 million of that, just that product this month.
Well, it's interesting. I didn't want to cut you off, but I want to get out there because you mentioned it's a 30-year note, right? And so typically when I work with a lot of people in the real estate space, the banks are limiting and making people do like 15 to 10-year mortgages. Yet, if we can understand the economic concept, right, with what I do in my business, right, helping people understand wealth, that if we can give the institutions a little bit of our capital over time, right, that's the way we want to do that. So is this program limiting how many, like if a person has 100 real estate portfolio, can they refinance, or is it only new purchases?
No, it's mostly right now. What we're doing is mostly refinances. So I'm like, for example, I'm taking my 750 properties, which are all financed with local banks that I've had to, cobble together, like $3 million lending limit at a time, and refinancing everything into this 30-year fixed rate product. There's no limit on the number of properties per investor. It's FICO driven. Like they want to see that you get at least a 680, well, it's really a 640 FICO, but you get better pricing above 680. But since they're looking at the rent from the property as the source of debt payment, they're like, hey, are you a stand-up person? You get a decent FICO and you got a rental property that is going to pay the mortgage, good to go. And so like our fastball is 75% LTV cash out refi right now, because we're just moving all that paper from the local banks into this product because it's the same rate and it's a 30-year fixed rate loan. It's just a better product.
And think about this from an economic perspective, right? Like if you can do some cash out refinance, like I help people understand that the equity is a 0% rate of return on your money. Right? And if we can understand that, because a lot of times when I'm talking to people are like, well, my equity, I'm like, do you understand what the equity is doing for you? It's a 0% rate of return, constant, always, forever. But if you can utilize that equity and go do something more, now this is on real estate investing, I'm not talking about your personal homes or doing anything like that, but when we understand the power of leverage and other people's money, right, and control, that is a huge thing. And if this allows you to do that, that's a huge value for people that you're probably providing.
Yeah, it's been a game changer for us. Like we funded the growth of our platform. We've raised private capital, friends and family money, 8, 9, 10%. And I've got equity sitting in my real estate, especially over the past couple of years. We've seen a lot of appreciation in the real estate side. So anyone who has a rental portfolio that's aged a couple of years has equity in their real estate. If you got corporate debt on your balance sheet, friends and family money, basically corporate debt on your balance sheet at 8 to 10%, and you've got locked up equity that you can go borrow on at 4, you're losing 4 points a year on that.
Yeah.
So that's
plus the opportunity cost on what you else can do with that money, right?
Absolutely.
Yeah.
So yeah, I bring that up because we've been having a ton of fun with that this year. That's been like something that we've gotten really excited about this year. Not every year do you have something that you're really excited about. This year I got really excited about that.
Yeah. Well, it can help change the landscape of, what you guys are doing. I mean, what's your thought on, the current economic environment and then things that are going on from a real estate perspective? What are you seeing out there from, not only on the long-term rental, but the flip and flips and these types of things that you guys are in day to day? What advice can you give to our listeners that are potentially interested in doing some real estate or things like that?
Yeah, sure. So we saw the Fed come out with comments, it was yesterday or the day before, saying that they're going to accelerate their tapering, basically stop by March in terms of their MBS, mortgage-backed securities purchases and treasury purchases. And, the market's expecting 3 rate hikes next year.
Yep.
So, I think that it is prudent to start factoring in a higher interest rate environment on your exit. If you're looking to do a 3 or a 5 or 7 year deal, and your proposed exit cap rate is today's cap rates, I just don't think that's practical.
You got to adjust that for sure.
Yeah, you got to take that into consideration. So I mean, we're expecting, because of, I believe anyway, that inflation is, it's not a transitory thing, that it's going to be a little bit more stubborn than the Fed is even still giving it credit for.
Yeah.
We love owning hard assets right now. So the idea of owning hard assets that should have some rent increases and locking in today's rates from a fixed rate debt point of view, I'm like, that's just a winning combo, right? Like that's just locking in the win. So that's something that we're highly focused on right now. And I'm frankly refinancing everything as fast as I can and locking in these long-term rates because I think that rates are going up and I just want to lock in as much of a win as I can before I look back and say, shit, I should have.
Right.
So that's one thing that we're particularly focused on. In an interest, there's been such a tailwind behind residential real estate in terms of the undersupply that I do think that even with some rate increases, I think it'll soften the market. I don't really think it's going to.
I was just going to ask that when you see. I was just going to ask that when your opinion on is because typically when you start to see rate increases going up, property values tend to come down. Do you anticipate that happening at all, or what you're just saying probably contradicts that a little bit?
Yeah, I mean, I think that they are opposing forces. They certainly are opposing forces, and it's the relative strength of the two that is like the debate, right? So, I'm personally of the mind, I think it's going to soften the market. I don't think it's going to actually lead to nominal decreases in home values for homeowners. I'm a little bit more nervous on the multifamily side because going in cap rates these days are so low and you're having an increasing interest rate environment. The inference there is that the sponsors on multifamily syndications right now are counting on rent increases. And it may happen. Like, I'm not saying it's not going to happen, like, especially in an inflationary environment, if that's your bet, like, yeah, rents tend to track, well with inflation. But that's really like the crux of the thesis there, right? I just think, I think it's an interesting time. I was looking at this graph the other day of interest rates over the past like 80 years. And we've been, but for like little bumps back up, we've been in a consistently declining interest rate environment since 1985.
Yep.
I don't know anybody who is actually operating real estate. Like, I don't know anybody alive, right? Like, none of my contemporaries or peers, like, were actually operating real estate in a consistently increasing real estate environment. Those guys are much, much older than I. And so I think that's something that everyone should just keep in mind, right? Like, none of us in the room right now have ever really done this.
That we know people who have, right? And even in my end, is like looking at the interest rate decline, like at some point in time with all the money printed, all these things, I mean, eventually this stuff's going to hit the fan and it's going to have to happen.
I think so. I mean, I think so. I think it's going to lead to a different set of circumstances, a different set of macroeconomic risk factors that we're just not used to thinking about, and then it'll happen. We'll get smacked upside the head and then we'll be like, oh yeah, of course. Like, that makes sense. But right now we're not thinking of it,
Right. Yep. Yeah. It's interesting. It's the world is an interesting place right now, isn't it?
Oh yeah. I think there's a fair amount of risk in the environment that's not being priced in right now.
Yep.
But it'll be fun, it'll be fun for sure. There'll be lots to talk about.
It'll be learning opportunities for sure, right? Yeah. So Jack, do you guys do any coaching with people that want to get in the space? I mean, is that your deal, or are you guys more focused on growing the Dominion and lending?
Yeah, no, we're more, we haven't really done, we don't really do anything on the coaching side. I mean, the lending platform ends up being kind of the way that we interact with folks who are actively doing deals. And so, obviously we do underwriting internally. So like, there's active feedback between our team and the flippers that we work with on the lending side. And enjoy that. That's really fun to do. But we've mostly been just, we're operators ourselves. We grow the lending business. We're real active in the space, but haven't focused much on the coaching side. Frankly, when it comes to culture index, predictive index, we're just not coaches. We're operators. So that's what we're doing. We keep our nose down and focus on that.
Well, don't fix it if it's not broke, right?
It's all good. We got plenty of work, so it's all good.
So if someone out there listening and wants to talk to you more about this lending option, especially what we were talking about as far as these rates and these options for real estate portfolios, how can they get hold of you and contact you to get more information on that, and even your lending arm?
Yeah, sure. So the rental loans product, that 30-year product, is www.rental-loans.com. So that one's pretty easy, rental-loans.com. And then on the fix and flip side, it's dominionprivatelending.com. Those are our websites for the lending business. So yeah, happy to, it's really easy to get a quote too. It's doesn't cost anything. You need basically, it's such a simple product. You need like 5 data points. It's what's the address, the property value, you know, what's going to appraise for, what's the rent, what's the property taxes, what's the insurance, and what's your FICO. And we can get you a quote with that. So it doesn't cost anything. It's really easy. Get you a quote the same day, next day. So yeah, we've been doing a ton of that. That's what I'm the most excited about right now. So
well, it's an opportune time for it, especially with what's going on, and you know.
Yeah, it became very relevant very quick. You know, 6 months ago, I was like, yeah, this is a great product. Now I'm like last call. I'm for our own portfolio. I'm like, I need to do this now.
Right.
So yeah, it's been good.
Yeah, well, you'll be busy doing those 750.
Yeah. We are. I am. It's a lot of appraisals, unfortunately.
Well, you're keeping somebody busy.
Yeah, for sure.
Well, awesome, man. Well, I really appreciate you jumping on and sharing some insight and knowledge, and especially around some of the things that some of the awesome things that you guys have going on. So again, Jack, thanks for jumping on. And if anybody has any questions, reach out to Jack, the websites that he gave you, and his company or his team will get in contact with you. So,
no, thanks, John. I really enjoyed the conversation. Really appreciate you having me on.
Yeah, man. Looking forward to the next time.
Absolutely.
All right. Thanks.
Sounds good.